In this lecture, we will explore the topic of financing strategies, funding a client's prioritized goals. By the end of this lesson, you should be able to describe life cycle goals and needs that typically need to be funded, discuss ways of financing the client's prioritized goals, compare and contrast the advantages and disadvantages of various types of debt, and explain the pros and the cons of buying versus leasing. One of the first tasks in the 6-step strategic financial planning process is goal identification. What is the goal? What's the time horizon? How much will be needed to fund it? How are the client's goals prioritized? Because you know there's going to be multiple conflicting goals. The goal table shown on this slide from RTD Advisors and adapted from George Kinder lists a number of categories. Notice how the data collection questionnaire asks the client to consider the short term, the intermediate term, and the long term. Questionnaires are quite useful in systematically gathering client data. Clearly, each of our clients are unique, but a good starting point for planning purposes is to look for commonality of life cycle needs and goals. Then you can customize for your client's unique situation. 5 useful age and career groupings are depicted here. The starting out years, ages 18 through 25, the nesting years, ages 25 through 40, the prime years, ages 40 through 55, the wealth accumulation years, age 55 through 65, and the reinvention years, age 65 and older. In the starting out years, ages 18 to 25, common financial decisions involve funding education, finding employment, purchasing a car, and managing student and consumer debt. Significant financial decisions in the nesting years, those ages 25 through 40, center on career, family, housing, mortgages, and auto loans. During the prime years, ages 40 and 55, typically the focus will shift towards funding education for the children and making decisions on how to use discretionary income. By age 55 to 65, that wealth accumulation years, the focus moves towards retirement, maintaining lifestyle, and estate planning. In the reinvention years, age 65 and older, significant financial decisions need to be made regarding funding retirement living needs, estate planning, and gifting. Again, these issues offer just a starting point in your discussion and in your inquiry. Do they apply to your client's situation? Goals are often funded out of assets, including cash and cash equivalents, the sale of securities or property, withdrawals from savings or retirement accounts, bonuses or cash windfalls such as gifts or inheritance. However, for many, goals are funded fully or partially from consumer credit. Common sources of consumer credit are credit cards, school loans, home mortgages, home equity loans, reverse mortgages, lines of credit, and personal and family loans. Let's take a moment to examine a few debt terms. Secured debt is debt where there's collateral used to protect the lender from default. Unsecured debt, no collateral is provided to the lender. In a recourse loan, the debtor is personally liable on the loan. In a non-recourse loan, the debtor has no personal liability, but their credit rating may be impacted by non-payment. 2 broad types of consumer credit are installment loans and revolving credit. Installment loans are contracts that are clearly specified in regard to terms of the loan, including loan amount, the number of payments, the amount of the payment, the due dates for the payments, the stated rate of interest, etc. Examples of consumer installment credit include a home mortgage, a home equity loan, auto loans, student loans, and personal loans. Revolving credit or open credit loans are quite different. They offer a pre-approved line of credit to consumers with a certain credit limit. No financial charge if the amount is paid by the due date, typically by the end of the month, and there's high interest rates thereafter. While the consumer will be expected to make a minimum payment, there's flexibility in the actual monthly payment made. Providers of consumer debt include banks, finance companies, credit unions, auto dealerships, brokerages, etc. We'll examine financial institutions in another lesson. Open account credit includes bank credit cards, retail charge cards, and revolving lines of credit. Credit cards are offered by financial institutions, and retail charge cards are offered by retail merchants. Both extend credit before it's used, subject to a credit limit. This type of consumer credit is offered with pre-established repayment terms and monthly minimum payments. Revolving credit lines do not involve a plastic card. Rather, funds are accessed by writing a check on an existing credit line. The account may be unsecured, for example, a personal line of credit, or secured, for example, a home equity loan. Mortgages are secured loans that have real estate as collateral. There are numerous types of mortgages. However, some of the most commonly used ones are the conventional or fixed rate mortgage. This loan has a fixed interest rate over the entire term of the loan. Typical loan periods are 15-year or 30-year loans. The adjustable rate mortgage. The adjustable rate mortgage has an interest rate that is reset periodically. Often the rate is linked to some benchmark, for example, like the prime rate plus a premium. Sometimes there is a 1-year teaser rate, a very low interest rate, to encourage borrowers. Balloon payment mortgages is a mortgage often thought of as interest rate only. At the end of the loan period, the holder needs to make the entire balloon payment. In actuality, any loan that requires some lump sum payment at the end of the period, i.e. it's not fully amortized, is a balloon payment mortgage. The reverse mortgage. This mortgage is a method for senior citizens 62 years or older to withdraw money from equity on their home, either as a lump sum or as an income stream. The loan repayment is deferred until the owner dies, sells the home, or leaves the home. For example, to enter into assisted living for an extended period of time. This slide depicts some of the reasons that a client might decide on a fixed rate or an adjustable rate loan. The fixed rate loan makes sense for the risk-averse investor that plans on keeping the loan for a long period of time. For example, the homeowner that takes out a 30-year fixed mortgage. The cost can be budgeted. There won't be any surprises down the line. This loan makes a lot of sense if you anticipate an interest rate increase or rising inflation. The variable rate loan pushes the interest rate risk onto the borrower. This loan probably makes sense for the person who doesn't plan on keeping the loan for a long period of time. It is especially attractive if the borrower can take advantage of the low teaser rates in those beginning years. Note that a client must be willing to deal with uncertainty of debt payment amount if the intent is on holding that variable rate mortgage for a long term. The total monthly mortgage expense includes a principal payment, an interest payment, a portion of the annual property tax payment, and a portion of the homeowner's insurance premium payment. If the borrower did not have enough money, sufficient down payment, typically 20%, then the lender may require a payment for mortgage insurance. Home equity debt is a fixed rate amortized loan that is secured by a second mortgage on the home. The borrower essentially uses the equity in the home as the collateral. One advantage of this type of consumer debt is that the interest is usually deductible, subject to limitation caps. Home equity loans are often used to pay for college tuition, to renovate homes, and to pay medical bills. A home equity line of credit is a promise by the lender to loan up to a certain amount of money. The credit line is extended for a period of time. For example, it might just be 1 year, or it could be longer. If the homeowner decides to take out the loan, then it would work just as described. A line of credit might be used as a source of emergency funds. The table in this slide highlights the differences between the home equity loan and the home equity line of credit. The home equity loan is a fixed rate amortized loan. The full amount of the loan is received by the borrower at the time of escrow. Interest payments are tax deductible and monthly payments are predictable. In contrast, the home equity line of credit is a variable rate. The borrower only takes out the amount of money needed. If the need increases with the term of the credit line, then additional money can be borrowed. The repayment schedule is flexible. Similar to the home equity loan, interest payments for the HELOC or home equity line of credit are tax deductible. 4 items to consider when helping the client determine whether to fund a goal with assets or with a loan, if this choice is available, are debt capacity. Does the client qualify for the loan and can it be serviced? Cost of the debt. What is the after-tax cost of the debt? Opportunity cost. Is the cost of the debt less than what could be earned with the asset? Is the goal an appreciable, for example, real property, or is it a depreciable asset? Psychological comfort with debt. What does the client think about holding debt? The decision to buy or rent a home is based on several factors. First, it depends on how long you intend to remain in the home. If it's only for the short term, then there is a better argument for renting. The transaction cost of flipping a home will reduce the likelihood of any capital gains. Second, it depends on whether the person has the money for a down payment and the person's ability to service the loan, i.e. to make the loan payments. You will notice other factors on this slide, including the potential for capital appreciation, pride of home ownership, tax deductibility of mortgage interest, and expectations regarding the real estate market. Some clients may be faced with the decision about whether or not to buy or lease an automobile. Generally, leasing for personal use is not as advantageous, primarily because you don't get the benefit of the tax write-off that a business would. Leasing a vehicle for business purposes is another story. To make the determination, the practitioner needs to know the value of the potential vehicle, the miles to be driven each year for both business and personal uses, the length of time the automobile will be held, and whether there will be any trade-in, etc. Our personal property lease versus buy discussion in this lesson is limited to automobiles. However, realize that clients living temporarily in a location may consider leasing furniture, or the small business may consider leasing office equipment. It always comes back to the cost-benefit analysis. Part of the benefit is that you conserve cash for operational or living expenses. In this lesson, you learned about life cycle goals, needs that typically need to be funded, ways of financing a client's prioritized goals, the advantages and disadvantages of various types of debt, and reason for buying versus renting or leasing.